Inflation and deflation are two of the most powerful forces shaping the economy, and understanding them is essential if you want to protect your money, grow your wealth, and avoid financial mistakes that catch most people off guard. Inflation is when the prices of goods and services rise over time, meaning the same amount of money buys less than before. Deflation is the opposite. It is when prices fall, often signaling weak demand, slowing business activity, and economic uncertainty. Most people assume inflation is always bad and deflation is always good, but the truth is more complex because both can damage your finances if you are not prepared for them. During inflation, your savings lose purchasing power, the cost of living increases, and everyday essentials like groceries, rent, fuel, and utilities become more expensive. Inflation also affects investments. Cash becomes weaker, bonds lose value, and borrowing becomes more costly as interest rates rise. But inflation can benefit you too if you understand how to position your money, because assets like real estate, commodities, equities in strong companies, and inflation-linked bonds often rise in value during inflationary periods. Deflation, however, brings its own set of challenges. Falling prices sound good at first, but they usually indicate that businesses are earning less, consumers are spending less, wages stagnate or fall, and unemployment can rise. People delay spending because they expect prices to drop even further, which slows the economy even more. Investments such as stocks tend to struggle because company profits decline, and property values may fall, reducing the wealth of homeowners. Deflation can also increase the real value of debt, making loans harder to repay over time. This means both inflation and deflation can erode your financial stability if you do not prepare. So how do you protect your money in both scenarios? First, diversify your income and investments. In inflationary periods, focus on assets that rise with inflation, such as real estate, energy stocks, commodities, index funds, and treasury inflation-protected securities. If you rely only on cash savings, your wealth will shrink as prices rise. On the other hand, during deflationary conditions, safety becomes more important than growth. So a portion of your money should be allocated to secure assets like government, bonds, high-quality savings accounts, and emergency funds with at least 3 to 6 months of expenses. The key is balance. A well-diversified portfolio protects you in both environments. Second, track your expenses and adjust your budget according to economic conditions. When inflation rises, review your spending, cut unnecessary costs, and prioritize essentials. Look for fixed-rate loans rather than variable ones, because locking in your interest rate protects you from rising borrowing costs. When deflation appears, income stability becomes more important than ever. Strengthen your emergency savings, avoid unnecessary debt, and focus on building skills that increase your employability in a slower economy. Third, stay informed. Inflation and deflation do not appear suddenly. They build over time. Pay attention to interest rate decisions from your central bank, consumer price index reports, labor market trends, energy prices, and global supply chain conditions. These signals help you understand whether the economy is heating up or cooling